Okay, so let's unpack this.
Let's do it.
It is Monday, February 2nd, 2026. And if you've been anywhere near, I don't know, a financial news feed today.
Or honestly, just glanced at your phone.
Right, just your phone. You probably saw the fireworks. Palantir Technologies just dropped their Q4 2025 earnings.
And the reaction has been, well, hysteria is probably the right word.
Hysteria is a good word, but it feels like a divided hysteria.
It does. It feels like we're watching two completely different movies playing on the exact same screen.
That's the perfect way to describe it. On one side, you've got this Iron Man narrative.
Mm-hmm.
Palantir is the invincible superhero of the AI age. They're everywhere. They're growing like a weed.
And on the other side, you have people screaming that the sky is falling because the stock price is just too high.
So that creates this massive tension.
It's the classic heavyweight fight, growth at any price versus, the iron law of valuation.
And today, we're going to see who gets knocked out. So that's our mission for this deep dive. We've got a fresh deep value intelligence report that's generated this morning right alongside that Q4 data. And we need to answer the billion-dollar question.
Is Palantir the next Microsoft?
Exactly. Destined to rule the tech world for decades.
Or is it Cisco in 1999, a great company that's about to incinerate a generation of investors?
To answer that, we have to look at the fundamentals, the sentiment, the technicals.
And I'm warning you now, the answers might not be what you want to hear if you're holding the stock.
Well, let's start with the stuff that people do want to hear.
The good news.
The good news, because frankly, the business performance looks incredible. I was looking at the release this morning, and the revenue number just jumped out at me.
$1.41 billion for the quarter.
Which is up 70% year over year. I mean, for a company this size, that's unusual, isn't it?
It's incredibly rare. Usually, as companies get bigger, the law of large numbers kicks in, growth slows down. Palantir is actually accelerating.
No, what's even more interesting than that top-line number
is where the money is coming from.
Right, because for the longest time, the knock on Palantir was, oh, they're just a glorified defense contractor.
They build spy tools for the CIA.
Yeah. But looking at this breakdown, that narrative is dead, isn't it?
Completely dead. The government business is steady, sure, but the explosion is in U.S. commercial revenue.
How much is that segment up?
It's up 137% year over year.
137%.
Okay.
That's insane.
It's the inflection point that the bulls have been praying for. It proves this isn't just for hunting terrorists anymore.
This is for enterprise.
This is for banks, car manufacturers, hospitals. They've cracked the code.
And here's the other thing that caught my eye. Usually when I see a tech company growing at 70%, I assume they're just setting piles of cash on fire to do it.
You assume they're burning cash.
Yeah, spending $1 to make 50 cents. But Palantir seems to be actually making money.
They are printing money. Their GAAP operating income was $575 million.
Wait, hold on. On $1.4 billion of revenue?
Yes, that's a 41% margin.
A 41% margin. Okay, that is just showing off.
It is elite software territory. In the software world, investors often talk about the rule of 40.
Right, the benchmark where your growth rate plus your profit margin equals 40, and you're doing great. And Palantir is, let me do the math, 70% growth plus a 41% margin.
Yeah.
That's 111?
They are shattering the rule of 40. They're practically operating by a rule of 100.
What does that show you?
It shows they have pricing power and they don't need to burn cash to acquire customers anymore.
So why now? I mean, what changed? Palantir's been around for 20 years. Why did they suddenly catch fire in 2025 and 2026?
Well, it really comes down to two specific things.
Okay.
The ontology and the boot camps.
Okay, ontology.
Yeah.
I feel like I need a philosophy degree just to say that word. I see in the marketing all the time. But what does it actually mean for business?
It sounds abstract, but it's actually very practical. Think of it this way. Most companies are just a mess of disconnected data.
The classic silo problem.
Exactly. The factory has a spreadsheet, the shipping department has a different database, the sales team has a CRM. None of it talks to each other.
Right.
Now, most AI, like the chatbots we all use, it just predicts text. It doesn't know your business. Palantir's ontology builds a digital twin of your entire organization. It maps all the relationships between everything.
Okay, give me a real-world example. How does that look in practice?
Okay, picture a huge manufacturing company. A hurricane is forming in the Atlantic.
Right.
In a normal company, the CEO is panicking. He's calling the supply chain VP.
Who's calling the factory manager.
Who's checking a spreadsheet to see if the parts will arrive. It takes 3 days just to figure out the exposure.
And by then, the hurricane is hit.
Right. With Palantir's ontology, the system sees the weather data, it understands, it impacts a shipping route, knows which factory needs those parts.
And it does what?
It automatically reroutes the supply chain to a different port before the CEO even hears about the storm.
So it's not just reporting the news, it's changing the outcome.
That is the difference. It turns the company into a single living organism that reacts in real time. That is why companies are paying up.
And that leads into the boot camps. I'm assuming this is how they're selling it.
Yes. In the old days, selling enterprise software took, 6 to 12 months?
Dinners, golf, pilot programs.
All of that. Palantir scrapped it. Now they run 5-day AIP boot camps.
5 days.
They walk into a client, plug into their data, and build a working use case like that hurricane example in less than a week. The client sees the value instantly.
The report calls it operational escape velocity.
That's a good name for it.
And that explains the 137% growth.
Okay.
I mean, once you see that magic trick, you're probably not going to say no.
You're not. And once you build that digital twin,
You're not going to delete it next year.
that's the moat. High switching costs.
Ah.
If Palantir becomes the nervous system of your company, ripping it out is operationally fatal. You just won't do it.
And the balance sheet.
Fortress Financials. They have about $6.4 billion in cash and zero debt.
Okay. I'm sold. The business is amazing. They're printing money. They have a moat. I'm ready to pause the deep dive and go buy shares right now. Why shouldn't I?
And this is where I have to be the party pooper.
Uh-oh.
We have to pivot from admiring the engine to looking at the price tag on the windshield.
I have a feeling you're about to ruin my mood. What is the stock trading at today?
Around $146, maybe $147 per share.
Which sounds fine. I mean, lots of tech stocks are hundreds of dollars.
The share price itself doesn't matter. It's the valuation relative to earnings. At that price, Palantir is trading at a price-to-earnings ratio, a PE, of somewhere between 300 and 343 times earnings.
300 times earnings.
Yes. And the price-to-sales ratio, it's roughly 90 to 118 times sales.
Wait, 90 times sales, not profit.
Correct. For every dollar of revenue they bring in, the market is paying $90 for the stock.
Wow.
To put that in context, there's a famous Buffett rule mentioned in our source.
that rule?
For a growth stock to justify trading at 10 times sales, it's considered expensive. To justify 90 times sales, the company effectively has to become the single most profitable corporation in the history of capitalism within the next decade.
But hold on, let me play devil's advocate here. This is the AI supercycle, right? This isn't just normal software. This is the Industrial Revolution 2.0.
I know the argument.
Shouldn't we pay a premium for the company that's building the operating system for the future? If I missed Amazon in 2000 because it had a high PE, I'd be kicking myself today.
That is the growth at any price argument. And
Right.
it works until it doesn't.
So what does the math say?
Let's look at the actual math in the report. They ran a discounted cash flow analysis, and that's where you try to calculate what all the future cash is worth today.
Okay, and did they bake in the AI supercycle?
They did. They assumed an optimistic scenario where Palantir grows at 30% every single year for 10 years.
Which is almost impossible.
You know how hard that is? Almost no company sustains 30% growth for a decade.
Okay, so assuming they pull off that miracle, what is the stock worth?
About $47 a share.
Whoa. Wait, it's trading at $147. You're saying the fair value, assuming everything goes perfectly, is $47.
That is the danger. The market is currently paying a 200% premium over a perfect outcome. There is zero margin of safety.
So if growth slows to 25%, or if margins dip,
The valuation collapses.
that sounds like a long way down. But has this ever actually happened? I feel like people always say tech is a bubble and then it just keeps going up.
Oh, it has happened. And the source material draws a very specific and honestly a very painful comparison.
Which is?
Cisco Systems in 1999.
Oh boy, the dot-com crash.
We have to talk about this because the parallels are scary. In 1999, Cisco was the Palantir of the internet. They made the routers, the switches,
They were the plumbing of the web.
and the narrative was the same. The internet is the future. You need Cisco to run the internet. Therefore, buy Cisco at any price.
And here's the tragic part.
The investors were right. The internet was the future. Cisco did become the backbone of the web. The company succeeded beautifully.
But the stock didn't.
If you bought Cisco at the peak of the hype in March 2000, you paid about $80 a share. The valuation was detached from reality, just like we are seeing today.
So how long did it take to get your money back?
Do you know how long it took for those investors to break even?
A few years. 5 years.
20 years.
20 years.
You didn't get your money back until 2019. Think about that. In those 20 years, you missed the rise of Apple, Amazon, Google.
The entire cloud revolution.
You sat on dead money for 2 decades because you paid the wrong price for a great company.
That makes my stomach hurt. It's the opportunity cost. It's not just losing money, it's missing everything else.
That is the trap. A wonderful company can be a terrible investment. The AI research team believes Palantir is Cisco 2.0. The business will win.
But the shareholders who buy today will lose? That really puts the FOMO into perspective. It's not about missing the boat. It's about making sure the boat doesn't sink. So let's look at the market right now. Today, February 2026. What are the charts telling us?
The chart is actually flashing some serious warning signs. It's ugly.
Really? Even with the earnings beat?
Yes. The report highlights that the stock recently broke below the 200-day simple moving average. That was sitting around $159.
I hear about the 200-day line a lot. Why is that specific number so important?
It's a line in the sand for institutional investors. Pension funds, mutual funds, they often use the 200-day average to define the long-term trend. When the price falls below that,
The computers start selling.
it flips a switch in their risk models from uptrend to downtrend. It signals the smart money is distributing selling into the strength while retail investors are buying the hype.
What about other indicators?
The RSI, the Relative Strength Index, is at 25.
Which means it's oversold, right?
Right.
Doesn't that mean we should buy the dip?
In a healthy market, yes. But when a trend is broken like this, an oversold signal often just leads to a dead cat bounce
So it rallies a little bit, sucks in a few more buyers.
and then rolls over to new lows.
And we have to look at the macro picture too. This isn't 2021 when interest rates were zero and money was free.
No. We are in the neutral rate era. The Fed funds rate is sitting around 3.25% to 3.5%.
So cash isn't trash anymore.
Right. You can go buy a treasury bond and get a guaranteed 4% or 5% yield. Or you can buy Palantir, which has an earnings yield of about 0.5% and massive volatility risk.
That's the hurdle rate.
When safe money pays 5%, risky money needs to pay a lot more to make sense. And while the geopolitical stuff, the conflict between the West and China, is definitely good for Palantir's business.
The geopolitical mandate doesn't give them a pass on math.
Exactly.
So let's bring this all to a head. The report lays out a debate between the analysts, the bull versus the bear. Let's do a quick cage match. What's the bull's best argument?
The bull think of the Peter Lynch or Stan Druckenmiller type says, don't fight the tape.
The rocket ship is leaving, get on board.
Basically. They argue Palantir is a rule of 60 company in a once-in-a-lifetime AI cycle. They say momentum is a quality all its own. Their verdict is tactical hold or buy.
Okay. And the bear?
The Warren Buffett value disciple says FOMO is not a strategy. They look at the downside. If the stock reverts to that fair value of $47,
You lose 70% of your capital.
correct. They worry about multiple compression. That's when the market decides, hey, maybe this isn't worth 300 times earnings, maybe it's only worth 30.
And if that happens, the stock price collapses even if the company keeps growing.
It's mathematical gravity.
So the drum roll moment. What is the final verdict from the AI research team?
The verdict is sell.
A hard sell, not even a hold.
Immediate liquidation.
Wow. That's aggressive.
Their reasoning is purely about capital preservation. They believe the risk reward is completely broken. They don't want to pick up pennies in front of a steamroller.
But they don't hate the company.
No, and I want to be clear on that. They have placed Palantir on the wonderful company watch list.
So they want to own this business.
They think it's an apex predator, but
But the price has to be right.
they have set a price alert at $50.
$50. From $147 down to $50? That feels impossible.
It felt impossible with Cisco in 2002. But eventually, price always meets value. They're content to sit on the sidelines, earn their 5% in treasuries, and wait for the fat pitch.
It really is about discipline. Choosing the pain of discipline over the pain of regret.
That's the essence of value investing.
So here is the takeaway for our listener. Palantir the business. An absolute beast. The operating system of the future.
Palantir the stock. A speculative bubble waiting to pop.
And the advice is to take your profits, move that capital into short-term treasuries, or maybe undervalued sectors like energy or financials, and wait.
Exactly.
It brings up a really provocative question to leave on. You should ask yourself, are you investing in the business reality of 2026? Or are you gambling on the hype of 2030?
And ask yourself if you can afford to wait 20 years to break even, just so you can tell your friends you were right about the technology. Being right about the tech doesn't pay the bills. Being right about the price does.
That is a sobering thought. Just a quick tip before we wrap up. If you want to keep track of the overall market temperature and see if we are overheating, you might want to check out the Buffett Indicator app on the iOS App Store. It's a great tool for seeing these macro valuations we talked about.
Always good to have a thermometer and a fever.
Definitely. Now for the legal stuff. Full deep value research reports can be found in the description links. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. The content is for educational purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions. If you want to listen to our full deep dive about this topic or access more advanced contents, welcome to join Deep Value Club membership or subscribe to us on deepvalues.ai. Don't forget to like this video. Much appreciated.
Thanks for listening.
See you on the next deep dive.